Welcome back to Talk Tickers. Today, we're digging into Frontier Airlines Q2 2025 earnings call. And let me tell you, this one's a real roller coaster. We're talking about a messy quarter, a massive strategic shift, and just an absolutely wild ride for the stock.
Okay, so let's just jump right in. Take a look at this. On August 5th, Frontier drops its earnings report, and bam, the stock gets totally hammered, down 9%. But then, fast forward just 1 month, and it stages this monster 55% rally. So the big question is, what did the market see a month later that it completely missed on day one? Let's dig in and find out.
All right, so first, let's look at the numbers that really spooked everybody. Frontier posted an adjusted loss of 31 cents per share. Now that missed what Wall Street was expecting by about 3 cents. You know, not a huge catastrophic miss, but hey, a miss is a miss, and the market reacted.
And it wasn't just the bottom line. Revenue also came in a little light at $929 million. That was about 1.4% shy of what analysts were looking for, and it was actually down from the same time last year. So right out of the gate, you can see both the top and bottom lines were feeling the pressure.
Now, if we zoom out and look at the whole picture, the challenges really start to pop. The airline went from making a profit last year to a $70 million net loss this quarter. And on top of that, you've got this classic squeeze. RASM, which is basically the money they make per seat, was weak. At the same time, CASM, their cost per seat, actually went up. Man, that is a brutal combination for any airline.
So what gives? Well, management had a pretty clear answer. They pointed the finger squarely at things they couldn't control. CEO Barry Biffle came out and said that really bad weather and a ton of air traffic control delays basically shaved 2 to 3 points off the results for the quarter. They were, you could say, flying into a storm, both literally and figuratively.
Okay, so this is where the story really starts to turn. This tough quarter forced them into a huge strategic pivot. And the key word you're going to hear a lot is capacity discipline. Now, all that really means in simple terms is stop flying planes where you're losing money. It's a shift away from just chasing growth at any cost, and instead focusing laser-like on profitability by making sure your flights actually match what people want.
So what does this new strategy actually look like? Well, it boils down to a really simple 3-step plan. First, they're just going to stop flying so much on the slow days, Tuesdays and Wednesdays when they're not making money. Second, they're going to take those same planes and crews and just pack them into the high-demand days. And third, and this is a big one, they're going to double down on building a really stable, high-margin business through their loyalty program and their credit card.
And this move immediately created this interesting trade-off. On the one hand, a little bit of a downside. Because planes were flying less often overall, their cost per seat, that CASM number, actually went up. But, and this is the bright spot, that loyalty revenue we just talked about, it absolutely exploded. It grew over 40% per passenger compared to last year. That's a huge number, and it shows you just how important this piece of the puzzle is.
Now, what's really propping up this entire strategy is the fleet itself. Frontier is pushing hard to modernize, and they're now at a point where 84% of their planes are these super fuel-efficient Airbus A320neos. This is so important because it gives them a built-in structural cost advantage, and when you're fighting for every single dollar of profit, that advantage is absolutely critical.
Okay, so let's pull back for the bigger picture, because CEO Barry Biffle made a really bold claim on the earnings call. He basically said that right now, nobody is making money flying domestically in the U.S. He argued that the only reason some of the big guys look profitable is because their international flights are subsidizing all the losses at home. And his big bet is that this kind of industry-wide pain just can't go on forever.
And you know what? He's already seeing the proof in the pudding. Frontier is watching its competitors back off, and they're backing off faster in Frontier's key markets. Biffle pointed out that competitors are cutting their capacity about 3 percentage points more in his territories than in the rest of the industry. What does that mean? Less competition, and for Frontier, more power to set prices.
So all of this tees up some major catalysts that investors are watching like a hawk. First, forward yields, which is just the fancy way of saying future ticket prices, are looking super strong, up 15% for September. Second, they're seeing a major competitor, and let's be real, everyone thinks he's talking about Spirit, pulling back from their routes. Third, you're seeing this huge shift in pricing. Biffle had a great line, 79 is the new 49 and 99 is the new 79. Basically, those rock-bottom fares are vanishing. And all of this is happening while that loyalty engine just keeps picking up speed.
So let's put it all together. On one hand, You've got this really messy quarter that justifiably caused a big sell-off. But on the other hand, you have this really clear, really compelling turnaround story that the market, well, eventually started to believe in. So the question for us is, what's our call on the stock from here?
All right, first up, our prediction for what happens next. Looking at the next quarter, we actually expect them to beat the high end of their own guidance. Why? Because those powerful sales trends and that 15% jump in future pricing we've seen since July are just too strong to ignore. The domestic market is getting healthier, and Frontier is perfectly positioned to benefit.
Now, what about the stock price? Look, I'd expect the roller coaster ride to continue. This is still a show-me story for a lot of people, but that underlying narrative of capacity discipline meeting a stronger market is just so powerful. We think the market is going to keep pricing in that turnaround, supporting the upward trend we've seen since that initial post-earnings dip.
And that brings us to our official rating on the stock, outperform. When you combine their new strategic discipline with a pricing environment that's getting better by the day, and you throw in the fact that competitors are backing off, well, you've got a really compelling case for this stock to beat its peers and the rest of the market.
And, as always, please remember this is not financial advice.